Hello and welcome to FinEdge, India's leading financial planning company. My name is Anirudh and I'm going to talk to you about the 3 mistakes that SIP or systematic investment plan investors typically end up making. Now, although SIPs can be run into any sort of mutual fund, these mistakes that I'm going to talk about are peculiar to equity mutual funds. Let's jump right in. Mistake number 1 is to start your SIP without understanding how SIPs really work. And this is especially true for those investors who are transitioning from low risk traditional asset classes like, let's say, recurring deposits, LIC or PPF. It's very important to understand that equity SIPs will not give you a linear return, the kind of return that you're used to. SIP returns can fluctuate and in fact remain low to negative for very lengthy periods of time, even months or years before they turn positive. And this volatility is the price that an investor has to pay for long-term wealth creation. So yes, start your SIP, but do understand how they work. Mistake number 2 is to stop and start your SIPs. Now, when do we typically stop our SIPs? We do so when there's panic in the market, when the headlines are crying bloodbath, when we're wondering whether markets will fall even further. As a result, we end up stopping our SIPs. What happens here is we lose out on the best possible opportunities for accumulation, because it is when markets are down that you will be accumulating the maximum number of units from your SIP. Similarly, most investors are spurred into action by the confidence of seeing past returns and therefore end up starting their SIPs only after markets have gone up. Now, in this seesaw of starting and stopping your SIPs at the wrong time, what happens is you miss out on the most brilliant benefit of SIPs, that is rupee cost averaging, the mechanism that ensures that you buy more units when markets have fallen and buy a lot less units when markets have risen and therefore assets are overpriced. Mistake number 3 is to start an ad hoc SIP. And by ad hoc SIP, I mean an SIP that's not linked to a particular goal. We all have goals in our life. Some of them can be really long term, like let's say our retirement. Some could be slightly less long term, like our kids' education. Some could be medium term, like putting together enough money to pay for the down payment of a new house. And some could be really short term as well, which is, let's say, buying a new car or taking your family on a great vacation. Irrespective of what your goal is, make sure your SIPs are aligned to them, which means you're saving with an end in mind. There are a couple of really important benefits to doing this. 1, it automatically makes you a lot better as an investor because it saves you from a lot of behavioral traps. For example, if your equity SIP is down 10%, but your goal is 20 years away, you will be a lot less bothered and will therefore be less prone to taking actions that could work to your detriment. Secondly, your investment risk will automatically be aligned to your tenor, which means your higher risk investments will be flowing for the long-term goals that you have. And in doing so, you are ensuring that there's a nice match between your goal tenor and the asset class you're choosing. So there you have it. SIPs are great investments, but make sure that before you start, you commit to not making these 3 mistakes. I'll sum it up for you. Mistake number 1, understand how they work. Mistake number 2, don't stop and start them. And mistake number 3, don't do an ad hoc SIP. Chalk out a nice financial plan and align your SIPs to your goals. I hope you enjoyed watching this. I wish you all the best and happy sipping.